Hello and welcome to Climate Salad's Lunch and Learn Capital Raising Workshop. My name is Charlotte Connell, looking after ecosystems here at Climate Salad. And before we get started, I'd like to acknowledge the traditional owners of the land in which we meet. For me, that's the Gubbi Gubbi people, and I pay my respects to their elders, past, present, and emerging. I'm going to hand over to our fearless leader and who's going to be running this workshop, founder and CEO of Climate Salad, Mick Liubinskas.
Thanks, Charlotte. Thanks, everyone. Great to be on here today. I want to start by just saying I'm also really open to how we run this for maximum value for everyone here. I know there's a really big range of companies in different positions and different stages of this. So happy to try to align this to maximum value to everybody as much as possible. Also being really, really clear that we're not going to solve all the problems in one session. So vast majority of the time, it's around a good discussion, hopefully some lessons learned, and then also what's the best follow-up from here. I was trying to find the best presentation to give here based on the different types of content we've got, but just to get a quick, either through the raise of hands function, is everyone okay with me spending just 15 minutes going over sort of some of the base principles around capital raising and then doing Q&A, or is everyone like done with the basics and happy more to go to more Q&A style? Sorry, thumbs up if you want me to do intro and Q&A. Don't do thumbs up if you prefer me to jump straight to ask me anything Q&A. Thumbs up, lots of thumbs ups. Everyone finding the thumbs up button. Good. Okay, we'll do some thumbs up then. Well, sorry, do some thumbs up. Yes, working through. Oh, hang on, I haven't even got you on my headset here, so that'll be a bit better for sound. Hopefully get onto that. So, so it's going to run through this really quickly. I think I've got an updated Climate Salad version of this, but I can't seem to find it, so I'm just going to jump straight in.
But I'd launch a little poll while you're searching for that.
Oh yeah, thank you. Great. I know we had moved some of this content over, but where is that document? I'll just go to this other content. It's fine. My apologies, team. Over the many years, I've got way too many slide decks for all this content. I'm just trying to find the best one for today's audience here.
Oh, we've got a seasoned cap raising pro in amongst the audience. You can jump in with some tips and tricks.
Yeah, please. Yeah, look, definitely one of the advantages of Climate Salad is that there's someone else who's been through what you've going through. So definitely great to grab that that value, so that support as well. So so let me share my screen. I'm also testing out. Actually, sorry, I'm going to unshare that. Move it over here, so I'm looking at you. So that's a bit better, because otherwise I'm looking away all the time. Okay, so I'm just going to run through some of this content, and then we'll get up to questions. But so enough about everyone knows about me. We know a bit about what everyone's doing here. But please put not a content in the chat. Okay, so we know that we've got a good answer there in terms of where people add in terms of the content and the quiz, so that'll be good for us to know. But in terms of what you're trying to get out of this, like in terms of major questions I can really address, or problems, or please put that into the chat, so then we can definitely I can address them as we go along. So and again, really, really important that the follow-up is actually most important. One thing I just want to start with, and again, it's something I see a lot, is what you read in the media about capital raising is like less than 1% of the story. So it feels like someone's just pitched someone in a cafe in down Palo Alto, and then they write them a $10 million check or something, and that's just a very poor representation of the overall process and challenge around capital raising. So try to just remove that myth as early as possible. Really, really key is avoiding that hype and focusing on the fact that you're growing a business. The capital raising gets way too much attention. People celebrate it. They talk about like, oh, with capital raise, and it's like, so what you've effectively done is sold a percentage of your business for some money based on a future promise. And so there's pros and cons around that and what it means, but it just gets way too much attention. And I think it's kind of binary for me, those people who see capital raising as just a tool to help me grow my business rather than something a startup does is really, really valuable. It can be hard to learn. It is complex at times, and there are real tricks to it. And definitely the second and third time you go through it, you'll find it significantly different. But also I'll say that it is definitely learnable. Like I'm not really at it. I've never done all. So your capital raise will be different to mine. Everyone's goes through their own journey, but it is learnable. There is support you get. There is good books like Brad Feld's book, etc., and good mentor support. So it is a little bit tricky, and it's worth taking very, very seriously, but it is, and it does take some time. Then it's one of the biggest things actually is the process and approach to it is more important, definitely more important than the pitch. Again, way too much emphasis around celebrating capital raising and way too much emphasis around a perfect pitch. It is learnable. So really, again, think twice about how you want to do this. And when I first started doing startups, it was basically, there was family, friends, and fools, and a little bit of angel money and no VC. So things have changed a lot. Now you've got Tractor Ventures with revenue-based financing. You've got debt. You've got combinations of infrastructure, balance sheet investing, family offices. Like there's a really big range. So definitely really, really think and get support focus first on what your business needs. Like really, really focus on what it needs first and where it's going, and then think about how to get there rather than saying, I want to do a capital raise. Really critical for me in terms of investor is it's not someone, a dumb person who doesn't need their money anymore giving you money. Like absolutely every stage, maybe at Series C and beyond, capital raising starts to be like it's more financial, but then it's about financial numbers. Nearly every single investment up towards Series C and D is still about making someone believe in a future of this business and believe that there's going to be hard work to be done to get across the line. And to do that, you need a partner. Like out of a round, you might have some people just putting some money in as a bit of a punt, but there's at least one person, and more typically, it's at least half of your money is going to come from people who would consider you to be a partner as well. And you looking at them as a partner, I think, is a really important, different mindset versus just, I get pitched every day on LinkedIn and people emailing me like, "You never heard of me, invest in my company." And it's pretty insulting, right? It's like, why would I do? Number one, even if I was a billionaire, I would be just writing random checks here and there. Like, it just doesn't work that way. And it's like, you're asking me to go on, it's like ask someone literally on a first date, ask you to marry you. Like, it's just like, you just don't know me well enough. That's an insult. So look for a partner. And what I do one thing I do to really help this is I try to think, can I get 10 times the value out of this relationship as a partner than from their money? So if they're putting in 100K, can I get $1 million worth of value? Would I pay someone $1 million to do what they're going to do for me over the next 5 years to grow my business? And it just puts that frame back on it to be like, how are they going to help you? Is it introductions? Is it support? Is it hires? Is it strategy? Is it more following investment? Like what is it? But just, if you start with that, and if you start with the view that you've got the valuable thing, they are boring ass investors. Again, I'm glad this is not being recorded and shared out, Charlotte. Oops, it is, doesn't matter. So they've got capital. They're not investors until they invest it, right? They're just people with money. They need your equity. And if you hold it in high regard and value it and treasure it, then they probably will too. But if you're like, hey, you want to invest in my business? I'm giving some away, give you some money. Then it's just the same attitude. That you get a negative response typically on the other side. So I'll go into that a bit more about relationship building, but again, starting with the view that think about it as a partner and think about 10x value. So I like to think about it to be like, first of all, what do I need to grow my business? Do I even need investment? Then it's about the right investor, then the right amount of money for your business, and then the right valuation. And this is another reason why, until you're at least halfway through your round, going to people, cold calls, or like people you don't know and saying, I want you to invest, X amount of dollars at X valuation is just, I think is the wrong move, right? It means it's not a partnership. Again, it's like going into a first date saying, hey, I've got a prenup here if you need it, and what should we name our kids, right? It's just the wrong timing to go and talk about that. Because if you got investment from a random person with no skills and value to be added, and it was, I don't know, $1 million at $4 million valuation, you might think that's a pretty good deal. And then you might get like, I don't know, Bill Gates climate fund putting in $1 million at $2 million valuation. You're like, oh my God, that's a massive different valuation, very, very different. But they're going to take you and make you a massively successful company. So the investor can totally change the transaction. And I've seen this as well sometimes. It's like the right investor wants to put in 5 million. And you're like, oh, hang on, we've been talking about a $5 million valuation. Like that doesn't work out. So again, this goes back again to my key theme, which is build relationships rather than go out and look for investment. So some of the different sources of funding, I won't go into this a lot. It's a lot of information out there, but family, friends, and fools, so really early stage capital. And again, this was really hard work back 10, 15 years ago when I was a teenager. It was there wasn't many around. Grants were really hard. I mean, you got EMDG and R&D offset, but it was tough, and it wasn't high value add, but made significantly stronger now. We've got so many good programs, etc. Then you've got advisory capital, and this is where you may be going to the next level, and you're getting someone to invest, not just because they've got money in there, or an auntie or an uncle, or they know you, but there's someone who really knows the industry, can add a lot of value. Maybe they're getting some vested options as well for playing an active role, and you can get a few of them putting money in. And this is one I've used ahead of a seed round a number of times, because then you go into the seed round with some really good support and momentum and a bit of capital. So advisory capital can be coming in that pre-seed stage. Angels invest their own money, and there's a really good and bad about that. The good is that they don't have to go through a big investment committee. They might do it off a good gut feel of liking you. But the bad is they can also change flippantly. Like they can be like, well, I'm going skiing tomorrow. Or, I had an angel investor once. He was about to invest and he went, I decided to buy a boat. And I'm like, good for you. You've got a boat now and I don't have my money. So, good and bad. One great thing about angels definitely is you should be able to go and build a relationship with them first. You should be able to talk to their cohort, right? Who have they invested in already, and to understand that impact. And then that goes back again to a partnership and a relationship, which is if you can get to know one of their portfolio companies and they're like, oh my God, this angel's amazing. They add a lot of value. They really help. Then that can significantly be like, great. That's good to know they're so good and it's valuable. Plus also an introduction from their portfolio to the angels. And this applies to seed funds and venture funds as well. But there's at least got a track record of successful angels. And there should also be a try before you buy on their side as well, in terms of they should be putting some effort into you and showing you that they're committed rather than just a check. VCs, really important to know that VCs are only for a very, very small amount of companies. It's a very particular financing model, right? And a lot of people don't know how it works, is that they think VCs are billionaires who put in money, and sometimes they are, but most of the time VCs are professional investors, and they have their own investors. They go to super funds, they go to Uni Super and they say, you give me $100 million, I'm going to invest it in 20 companies over a 10-year period. And if I invest really wisely, I'll give you back $300 million and I'll keep a profit of that. So their goal is profit of the fund. And they have to invest some money into it, but typically they are looking for, they're looking for you to be a strong possibility of a billion-dollar company. So, and this is why it's really important to know, number one, they invest over a lifespan. So if their fund is in its 5th year, they have to return all the money in year 10. They cannot go any longer. Some of those changes now, but they have to give it back. So they may not be able to invest in you because it's too long a notice. And if you say, I've got an amazing business which is going to be valued at $250 million, definitely, they're like, good luck, but we can't support that. They can only support swings at a home run. Getting my baseball analogy. Again, please jump in with chats with questions if need be. most of the time they're looking at, like in Australia, it used to be like a $2 million was like a Series A. That's quite a small VC round now because there's been more capital put in. Like there's just a lot more capital. But a good round is up 20%. But using something like Cake Equity or there's a lot of tools out there to talk about the capital raise. And there's a lot of planning around your money again, which you've got to think about for your own business. But again, just introducing kind of the different concepts. It is good to think about your path, right? So if you have, your co-founders might have 1 million shares, it's valued at $1, you go get some seed money in for 100K, and you issue more shares to get get that 100K in, 100K in, and that's how it works. And that's how you dilute, right? Now they own 9% and you own 91%. And again, Kate does a lot better job of showing this cap table, how it manages out, but it's good to have a plan around your business and think about, okay, we're probably going to need to raise all this money over this period, and we're going to have to, this is what we think we'll need to grow it to its full, and this is where we'll be to go and earn that stage. This path thinking complements really well with another workshop, post I have up called Building Block Planning, which makes you really think about the different stages. And importantly, if one of your stages doesn't show that you're absolutely ready for Series A funding, like a VC funding, which is typically you've got a great product that's already working, it's post product market fit, and you're scaling it. Like, it sounds like VCs are risk money, but they're actually highly risk averse because it's really risky what they're doing over in aggregate. So they're risk averse in what they're doing. They very rarely back pre-revenue companies. They say they do, and they do occasionally, but they're much more likely to fund you if you've got that business that's quite progressed. One way I like to think about it, if you look at my building block planning, which is basically saying, how do you build towards the business one layer at a time? If any of your steps you take in a business are jumping steps, then typically you'll stumble. That's my simple way of thinking about it. So if you've got an okay prototype and 2 customers who use it occasionally, and you're after $5 million, even if you got that, you're kind of skipping the stage of making the product fundamentally work. So there's a lot more to this, and I won't go into it too much, but rather to say, just like think about your path, and again, think about what's valuable for your business, and then reverse engineering the financing and capital raise could be the right fit for that. Terms are really, really important. So all the money in the world at the wrong terms can kill you in terms of, and like right now, I'm in multiple situations of companies that I've been mentoring through programs where there's board fights, CEO fired, like massive shareholder issues, founders splitting. So the terms are actually really, really important. So even if you said you got $10 million at a $1 billion valuation, it still could be a crappy deal if the terms aren't right. The good thing about this again is there is at least 50 people in Climate Salad who've done at least 3 term sheets and deals. So there's someone to talk to, because what the hell is a drag and tag? The first time I heard it, I was like, what are you talking about, right? It's even pre-money, post-money valuation, liquidation. There's a lot of complexity in here. And it only really matters if things go really, really well or things go really badly. But you've got to care about them now in order to be prepared for that. Now, I've always hated the saying, we'll cross that bridge when we get to it. Like, there's no bridge if you don't build it now. So the terms are part of that bridge building, if that makes sense. Again, please, Charlotte, jump in if there's any questions, or if I'm going too fast or too slow.
I totally thought you said drag and turd. Sorry, I had
drag
a
and turd. Drag that turd along. Like, I do have some investments which feel like I'm dragging a turd, but
there are a few questions here. Do you want me to shout them out, or Ryan, Matthew, would you like to shout them out?
Give me 2 more minutes. I'll finish this really quickly, and then we'll go to questions, and we can jump. And this is specifically on some of this. Actually, no, let's run through. So really quickly, who sets the terms? If you've got multiple investors looking at you, you set the terms. If you've got one investor, they set the terms. And in my experience, it's almost like if you've got multiple investors, you're 10 times likely to have any round at all. Like if you only have one investor looking at you, it kind of just sets a scene that it's too risky for you and for them, and it probably won't happen. So getting multiple investors is easy to say, but really, really important. Let me keep going through. Convertible notes and safe notes and things. Again, get advice around that. There's different ways to structure it. One day your investors could fire you. Quick quiz. First one to respond. What's the best kind of investment comes from? Chatting in the box. Come on. Best kind of investment comes from sales. Joanna, well done. Joanna wins bonus 12 common salad points, which can be converted for a salad in your local area. So thank you, Joanna. Best comes from your customers, right? I'm going to go through a couple of exercises. We'll share this afterwards, but what are you thinking? My business is going to raise $10 million from who? Because we need them as a partner, and it gives me how much runway. Okay, I'll share this afterwards. Repetition, being investor ready. This is one of the big ones, right? So people are like, I'm going to go capital raise, and it is a big job, right? Capital raising is a big job. But one of the biggest mistakes I see people make is they go way too early into full capital raising mode, and instead they don't take a model of building relationships and then closing capital. And this is the biggest lesson that I'll keep saying over and over. And again, hopefully people who've experienced agree with me, is the best way, and probably the way I've raised money 90 to 95% of the time, is to only ever be in one of two modes: building relationships and closing capital. So if you talk about, capital raising mode, like, you could say that I'm building relationships, but at that point, I may not even know how much money I need. I definitely don't know a valuation. I definitely don't know who my investor is, but I'm building relationships and then I'm closing capital. And I want to build relationships to the point where I have enough multiple investors looking at me that that I can then close with confidence. Whereas what Australian entrepreneurs sometimes do is, I'm raising $1 million. I've got someone says they want to invest 50K, and I try to build from 50K up. But what I'd rather do is build from $10 million of potential capital down to $1 million. Does that make sense? Again, I know it sounds easier, and the hardest thing by far about my model is you've got to start really, really early. Like, you've got to start. I like the adage, which is, do you capital raising planning with a hangover, because you've either you just closed your last round. That's when you should be immediately starting your next round, not because you're out there selling a valuation. You're building relationships with the next range of investors. And I'll see. We've got a couple of tools to go through this, but here's what do they invest in. Best to choose and invest. I'll keep going through this. Sorry. I'll share more of this bit later, but sorry, here we go. So one of the things that I talk about in terms of building this relationship, and the reason why it can be done efficiently, is because when you're building relationships, it's not a full-time job. You're doing outreach, you're meeting people, and you're building that investor list, and you're keeping them up to date with emails and email updates. And that's a really efficient way to get lots of investors along the path. So, and what I mean by that is, you don't want to invest based on a dot, you want to invest based on a line. So if you're, this is what, again, a lot of entrepreneurs think is like, I've just got a brilliant pitch, it's 5 minutes or it's 20 minutes, whatever it is, it's 12 slides. And at the end of that pitch, they're going to love it so much, they're going to write a check. And the reality is that there's the analogy to dating and marriage is actually really quite apt, right? Which is, Mick might set you up on a blind date with an investor, and I'm not going to send your entire resume and your white paper. It's going to be like, hey, there's an awesome climate tech company with an amazing founder. You should catch up with them for a coffee or have a 15-minute intro call. An investor's going to, most of the time, going to be like, sounds good. I invest in climate tech companies. I should do that. That's their job, is to meet companies. So that's the first date intro, right? And then you might go have a coffee or a 15-minute call, and you don't get them to sign an NDA because you're going through all of your IP in detail and covering your sales plan for 5 years. You get them excited about the business. Get them excited about what you're trying to solve. Melanie from Canva didn't go into meetings. I remember I was at one of their early pitches and dumb enough not to invest, but she just talked about how hard it is to design stuff and how important it's becoming, and how everyone's going to be a designer. You can talk about cash flow or how the product's going to fundamentally work. Like, she just made everyone believe there's a really big problem, and then it's like, and that's kind of fuel in the tank for then you solving that, right? There's multiple challenges to that. So I'm just saying, build up those as many investors as you possibly can, and then use monthly meetings and a mailing list to keep them up to date. So if you send something out every 2 to 3 weeks, maybe every month, that just says, here's what we've done, here's what we're doing, here's how you can help us, and kudos. So thank people in the network, right? And BCC, please do not CC or include everyone on it. Like, even though that sort of might create FOMO, but just basically BCC everyone. Do it through MailChimp if you want to track it, but do it from you, right? This is a personal email from you to your supporters. And they could be mentors, advisors, supporters, investors. The bigger and stronger that list, and the more you're able to cultivate that and build up that momentum. And then, so imagine building that up for a 6-month period. And then in the 6-month mark, you're like, you've all been tracking our growth. We're absolutely nailing it. We're going to raise a round. Who wants to invest? And if you have 50 people on that mailing list who have come to get to know you and like you, you've got a really good chance of raising that money. And again, compare that to the other model, which is, I've got one investor in for 50K. Let me hunt around for somebody maybe to invest. So again, these are some actual tools. So, and you get what I mean in terms of build relationships to the point where you've got the confidence that if you closed it, it'll close, right? And again, hate to keep using the analogy, but my hope is that most people, when they ask someone to marry them, are pretty sure they're going to say yes. And take the same philosophy for investors. Number one, you want them to say yes because you know them well enough. They're not jerks. And number two, like, you've built a relationship up where you're like, they should either be talking to you about it or asking or mention it maybe, or they really like you. But if you're not at that point, asking them to invest is just too much of a whiplash point. So again, more to follow up on this, but it's just a key principle I find is much more reliable. I had a company use this model. They end up having, like, running it like a marketing newsletter and a whole process. They had 600 people on their mailing list. I thought it was way too many. Their marketing was too slick, but they raised like $900,000 to fund their business, and it worked just because they ran the process, and it was the law of large numbers. So again, it doesn't replace it all, but it works as a model. As I mentioned, here's an example email. Here's some stuff we've done. Here's what we've done next time. Here's what we're doing. Here's how you can help. And thank somebody else. So if you go, hey, thank Nikki Shavak for amazing help. It's like, wow, Blackbird's helping. Okay, keep going. Yeah, investors want to know there are other people at the table. And again, so talk to 10 times the money you need. And we in Climate Salad Slack, there's a CRM spreadsheet which follows this model. It's really simple, but it basically says, talk to 10 times the amount of money. So if you need $1 million, talk to $10 million investors and keep building relationships until 3 million is qualified. Because if you need $1 million and you ask 3 people who like you to invest, you've got a pretty good chance that tension is going to close that round. And then you build it to close, right? So if it's an angel round, you can use the domino effect. So who's the first person to knock over, then go get the others. For a Series A, again, in Australia, most VCs co-invest nearly, and in climate, I don't think I've seen a deal in the last 2 years that wasn't multiple investors. So again, having multiple investors sometimes de-risks that as well. So more to do. I'm going through this pretty quickly. Always be closing. Oh, that's when we won't do that. So let me jump out of that. There's more to share around that, but again, really fast and furious, and I'll share some of this content down, but please, let's go section by section, and who's up for Matt? Bridge using advisors for Series A.
Yeah, so we're looking at a Series A next year, so we're getting in early, and just I've received conflicting advice, which is normal, and just around using advisors and how we should or shouldn't.
I think it's great to use advisors. Using an advisor who's going to get paid for the capital raise and then disappear is not great, right? So it's funny though, right? You would definitely use lawyers and accountants and other people as a part of that deal, but somebody who's doing two things about it is you can't outsource it to an advisor. Like you can't be like, hey, I'm the CEO, I'm busy running the company. You just go and raise me money and I'll keep going. Because again, through to Series C, they're investing in the team, which is the founder is a key part of that. So what I have seen work as an advisor, and this is what I've done personally as well, is, you know, I actually joined the company as an advisor with equity over 4 years, and I'm supporting them. And my key priority is building relationships for this capital raise. And there's been times when it's like, okay, I'm an unpaid advisor, but if you raise the round, I'm going to come on and be a paid advisor playing this role. But it's the difference you see is transactional versus relationship. And what investors don't want to do is like, I'm putting in $5 million, but Mick's taking off with 250K. Like that money's just out the door. Whereas Climate Salad, our network, the mentors, there should be other ways you can get those introductions, right? And this is interesting. We've been talking a lot about this at Climate Salad as a team. Like, it's a common problem we have is that founders just need help with this whole process. Like, it's really hard and it takes effort. Like even the communication and the CRM, like all that stuff is hard. So, but if it's about introductions like that, like if you're paying someone purely for the introduction, again, it's quite transactional. There are ways that can work, but you just got to be really careful about what it says to the investors coming in. Like what happens in the next round? I mean, obviously, if you're going to go public, you're going to need advisors to run that. You need to be underwritten. Like that's quite different. But at the early stage, people see it as either you haven't built relationships, you have the founder's not engaged, and there's money going out the door. So, but I have seen some. There are other investors who don't care. Right? There are infrastructure investors, there are global investors, family offices who are like that's normal for them. So it's really hard. Like my guess is someone like Main Sequence and Blackbird would be like, no, thank you. Like why? But there are investors that find that completely okay. So case by case, don't do it if you don't have to.
That's great.
And sometimes you can structure the transaction. So sometimes it's like 25% of the fee goes out after the raise and 75% is in equity. Like, okay, cool. We're all in this together, right? So
fantastic. Thank you.
Yeah, Robs. Next question, Ryan. Current economic climate and cap raise mode, reaching minimum. Should you go it, where's money or close it? You know, I've never ever been at the party for a company that's just sold or gone public, and someone's gone, man, if we only took slightly less money that time, we would have more tab behind the bar. So it's really hard call to make because the amount of money you raise and the how you raise it like does impact the business. But right now, I'm telling every single one, close money when you can, get in the bank, extend your runway. You know, this is that we've just had a 13-year bull run, and there's massive inflation and climate problems. Like I don't know, but it doesn't look great, and it's always better to have too much money than less. The other thing I'd say is once you close it, it doesn't mean you can't take any more. There's multiple companies we've been working with who have closed a round and then they got another great offer and they closed it either on a safe for a bit more. So you don't want to be always in capital raising mode. And it's another thing I see Australian entrepreneurs do a lot is like, well, I just need, you know, $225,085.50 to get through to January, and then I'll raise another $468,000. Like it's hard work. So raising the amount of money, again, easy to say. There's always that tension at that early stage of enough money to get you far enough to go to the next inflection point. But it's,
can I just add to that a little bit, Mick?
Yeah.
So I've managed to close this safe, and it's the minimum amount I believe I needed to achieve some big milestones for the business. But
yeah,
as I agree with you, I think more money right now in the bank's a much safer option for the company, myself, and the investors, the first investors. Have you ever seen, after a safe note, within months of that, doing an equity raise and using the momentum of that safe to then do a locked-in market val, you know, higher than what the safe is at very quickly?
Yeah, absolutely. So it's why safes with caps versus percentages are better, because they incentivize everyone to get the highest valuation. But again, go back to the right amount of money you need for your business. There are times when I use a safe note to get early money in and give a benefit to that. So you might say, hey, we're doing a priced round in April next year, but if you want to put in money now and a 10% discount on that round, you can do that. And that kind of builds up some momentum and cash in the bank ahead of that. So they're very strongly linked. If you raise money on a safe and then it's somewhere within the next 2 years, then the thing to think about is what is that money being used for? So if this money is your total money of your company to run it for 2 years and create all the value, then everyone needs to share. Everyone should share in the value you've created there, including that money. But if this is money that's just coming in ahead of a priced round, then I'll pay you a 5-10% discount on the priced round because you're taking more risk, like you're coming at a minimum before that. But you just want to look at all the investors and say, well, Mary put in $1 million 2 months ago before there was a minimum and before we closed out of the sale. And if anyone else had put their money in before that date got that deal, and if you put in now, here's the deal.
Okay, so it is fine to have a line in the sand and reapproach all those existing investors and be like, hey, we got the 500, but we still have another chunk left. These are the new terms. You know, do you want to come in and bolster us up and get involved?
You got to you do have to manage it properly, right? So people completely understand it. But I think
I don't want to offend anyone, right? I don't want to go back to some existing people that have seen my momentum. Yeah. And all of a sudden it's like the val cap's jumped. It's no longer a safe, it's an equity raise. And those first 2 people that came in, they get the discount, they get the val cap and you don't. But I still want you involved. You're going to provide value. You know, it's synergistic. Like I always wanted you, but you just had too much fear. That fear should be mitigated now because I've managed to close two seeds to come in on the safe and I still want you involved.
Yeah. Yeah. The reason I like having a board and other investors is that it means that when I'm a director, I'm representing other interests. And your job as a director, like your fiduciary responsibilities to all the shareholders. And so don't apologize for creating the best circumstances to grow this business. Like it is always a hard thing of negotiation because they do want them to become partners. It's the reason why, again, if your focus is on building this business and this capital raise is just a means to that end, then it means we're not talking about this capital raise. I'm trying to do this. So what we did is we got some money in because we needed to support these 2 new hires because we've got these 3 other contracts or these 10 orders. But now we need to fund the next 2 years. So here's another step we're doing. And if you want to invest on those terms, that's what we've decided to do as a business. So you don't want to make it too complicated, like because it's complications add hassle for going through the process. And also, you know, there's a kind of investor rule of thumb, which is like 3 complications is the wheels fall off. So if it's like, okay, there's a bit of maybe they've got to flip up to a US entity, or maybe there's a safe and then it's priced. But if there's another complication of like, you know, someone's grandmother's on the board or something, you're like, well, that's too many. You know, the American phrase is that's got too much hair on it. Never quite understood it, but you know, it's just like it's got so. Be really clear and just communicate really clearly. But again, one of the key things, the reason I always talk about the business and where we're going rather than a cap raise is because it makes it about a conversation, which is like, this is just a part of that. So it deflects a little bit in a positive way. But
it's a funny circumstance I didn't think I'd find myself in, where like you get the money and you want to just move on from cap raising and get going. And it's just that weird conundrum where it's like, I'm in this mindset. I've built some connections. I've built some relationships. I've got my mailing list going. Yeah. Do you give one last push and get that extra funding, or do you just get cracking? And I didn't think I'd be in that position. You know, it's a funny conundrum to be in.
Mate, I've seen you worked hard to build those relationships, and a lot of climate businesses have hardware elements and they have distribution elements, which are more challenging. But again, working really hard. What happens is it's really, really hard to get to the first half. Like 90% of the effort's like getting a rocket off the ground, right? 90% of the effort goes to get it started. And then closing it, everyone runs in, oh, hang on, There's a joke about being oversubscribed, right? It's like
That's exactly what I needed to hear. That little analogy is perfect, actually. And I think I'll put that last 10% in and try and get some more funding to achieve what we want to achieve. Thank you. No, that's really good.
And a really key thing about all this is having a plan B. And if your plan B is, and this was the Atlassian model, right? People were badgering them for investment, and they're like, well, we're profitable. So, and someone offered them a deal, they're like, no. So if you're desperate for the money and no one else is offering, then you take it. But if you've got 10 people offering you money, then you grow, right? Again, that's why, if you keep focusing on telling the story of growth, then people are like, I want to be a part of that story. Like, get on board or don't. It's not, should I or shouldn't I? So, yeah, awesome, mate.
No, thank you.
Murad.
Oh, hi, Mick.
Yeah.
So my question, once on the VC track, so is it generally easier to then focus on VCs entirely? So essentially, if you raise VC, you've got to set up the legals in a certain way, and there's a lot of, we're going through this process now, and we found that whole legal period there's a lot to it. And once that is all in place, you're basically set up then to be a VC company, and you've got that time frame. So should that then, I guess, be the sole focus from a fundraising point of view moving forward?
It's hard to mix rounds. And I've seen this a lot more in climate than I've seen in any other tech, is strategic investors. And we could talk about that we haven't really talked about that much, but they're very, very different element to come in. The VC process is actually really well trodden, and everyone's thinking about the total path, right? If someone's putting in a Series A, they're not thinking this is the only money you need and we'll sell you in 2 years' time for $100 million, right? They're thinking and this is part of what you have to sell to them is, we're getting the Series A because then next year we'll do a Series B, and then we'll do a Series C, and then we'll be at 100 million revenue, and then we'll go public. Like, it's really only one story, and it's because it works, right? Because of the public markets and how all those elements fit in, and the different VCs doing different stages. You can get off that roller coaster, but that's the exception rather than the rule. Crunchbase stats are still the same over the last 10, 12 years. Only 15% of the companies that do a round do the next round. So only 15% of A's do a B, and so on, which tells you that actually not everyone progresses, but people go different paths. Some people get to profitability, but not many. A lot of them die, of course. Some of them go debt. But it's kind of like you have to be pretty. When you get later stage, you can do mixes of debt and equity and other things. But typically early on, you're either bootstrapping and you don't need anybody, or you've got revenue-based financing, or you're on the capital raising roller coaster. And it's like the VC, their value partly is, great, all the angels introduce you to me, and I'll introduce you to the Series B investor. And it is such a production line. So again, I would start I'd start by saying again, where's my business going? What does it need? What are my options? Because then if you can go and say, you know what, I could just go and get debt, or I could go and take another approach, then it's just another option for you to take. But once you take a Series A, certainly in Silicon Valley, like it's a well trodden path. And their whole goal is growth or death, basically. So be prepared for that. Like Silicon Valley VCs and some of my friends are, they would rather see you go to zero, trying to be $1 billion company, than to slowly grow to $100 million company. So yeah, so you would typically stay on it and drive it, but if you have, that's your opportunity to go and pursue other tracks. But I would do them in very separate stages. But again, seek some other advice based on your business.
Thank you.
Joanna makes a really good point about the risk associated with investors. Like this is the reason why they build relationships and actually really speak to their if an investor doesn't let you speak to one of their portfolios, that's a massive red flag, right? And because they could be like, yeah, here they are, go and speak to all of them. They all love me, right? But maybe they don't all love you, maybe they failed, but you know, building that relationship, and you should be interviewing them as much as they're interviewing you. So I'll come back to your other one, Matt, in a second, just get to the other key questions. Thoughts on the process, switching modes when building relationships and running a process, raise mode. So yeah, so my rough goal, and this is, every situation is different, but if you can start really early and start building relationships around the vision of the business, nothing to do with capital raising, what you want to be is kind of like, wow, that's really interesting, I like what you're doing, way too early. You're like, yeah, no problem, I'm not trying to raise money, I'm just trying to get to know you. And you building relationships. 3 months later might be like, wow, I like where you're growing, I see you've hired another person, you've got 3 more customers, I like it. Probably still a bit early, yeah, no problems, all good. 3 months later, and again, the luxury of 6 months there to go and do this work. 6 months later, they should be like, yeah, you're really growing and you're doing well. Like, are you thinking about capital raising? You're like, so I want to get them to the point where it's at least a conversation, which is not a surprise, right? If they're pitching you, great, because you're building lots of relationships, but it's still a process, but there's a different process of like then going and raising the money. And again, go back to the business, which is, wow, we just actually, we did our first pilot in the US. It went really, really well. We've got 10 new leads in there. We need to hire a team. To launch in the US, we're going to need another $3 million. So reluctantly, we're going to have to go and raise money. And then again, go and have conversations. And if you can have 5 conversations with people really interested in you and you like them, and they go, we'd love to be your partner, here's what we're offering, versus going cap in hand and saying, please, please, please invest in me. That's when I would go and do it. So again, really different for angels versus VCs in those rounds, because angels, my model with angels is basically to try to get, and seed is to try to get 10, 15 people liking us, but at least 5, and then picking the first domino, right? Who's the one, if we get them to invest, then everyone else will follow, because it is very much a groupthink situation. No one wants to be the first crazy person to put their money into these things, right? So if you can get that, if you're like, because the way people invest is by being personally very confident based on knowing the company and the relationships, or borrowing that trust from somebody else, right? Like it's like, no, not interested at all. Oh, what? Mary's investing? Wow, she's amazing and she's the best, and I trust her implicitly. And if she's investing, I know she's done great DD. Thank God I don't have to do it. Sure. So the timing of that is really key. And the same thing around VCs. Like, it's very, very bold, but the Atlassian model, like how they raised their first round, was 2 years of building relationships, because they did this crazy thing of make a profit. 2 years of building relationships with about 20 VCs globally. They picked 5 that they really liked, like basically the world's best. And they said, we're going to raise, make us an offer. So like that's the boldest way, right? You go, and they generally did this. They said, you've got 4 weeks to, go and give us an offer back. And there's one data room, you're all going to share it. And anything you ask, we're going to put in that data room to share with everybody. And you get one bid, right? They did a silent auction with Excel and Sequoia and everybody. But they had amazing numbers, right? They were making profit. They had negative churn. Charlotte, good point. VCs will absolutely do their own DD and build those relationships. But again, the DD starts when you start building the relationship. It doesn't start when they do the term sheet. Like that's, there's an analyst who may look at that, but 90% of the DD is done before that time. Kate's right, that Venture Deals by Brad Feld, it's a great book, well worth reading. So I've rambled a lot there, but in terms of that process of VC, again, you want to be in control of it and be confident that you've got enough people at the table to go and go into that mode. And you've got to choose your approach, which is either let's go and have conversations. How do you want to be involved? How would you do it? But ideally, your goal is to get term sheets so you have options. So whether it's the bold Atlassian model of like, make me one offer, clock's ticking, or whether it's go and have 5 conversations and saying, but a deadline is really, really important. I've never, ever invested and I've never raised money without setting a deadline. if I say to you, if I said, hey, Maria, you owe me $20, remember, for that lunch, but, pay me back in the next 10 years or so. It's like, yeah, she's not going to rush out and, and give me some Bitcoin. She's going, it doesn't matter, right? So if someone says, hey, Mick, we're raising money, thanks for being all your support. We're closing in the end of August. Like, I have to think about this now, right? I have to think about this now, and I have to prioritize it. And that's what the decision they make is, when they're flicking through your deck, is this something I'm going to action, or do I let it go through to the keeper, right? And so if I've chatted to you 10 times, I really like what you're doing, and you tell me you're going to raise money, I'm going to drop everything. And you have to aim for this. I'm going to drop everything and go and work on that, because I don't want to miss out. Like, I want to, at least, if I miss out on this, then I'm going to feel exactly as Charlotte's saying to me about missing out on Canva. And again, the issue is, I saw probably, I think, 112 companies in that year. I saw Canva and couldn't distinguish them, but I'm not always wrong in retrospect. But
seriously, why did you say no? Is that a big regret? What was it like?
Well, so they didn't have Cameron Adams at the time. He was actually working in Pollenizer on an email startup. And they were, number one, I invested all my money in Pollenizer so I was running a startup doing startups, which rings bells. But so I didn't have a significant amount of capacity, and also it was massively risky. Like, didn't have a technical co-founder, and it was a few high net worths putting a little bit of money in to try to get off the ground. After Cameron Adams, I knew he was an amazing entrepreneur, but then the seed round had closed, right? So, so you've got to manage it your own way, but try to have as many options as you can by building those relationships early. And again, it stops it being about an amount of money and evaluation, like transactional, and is much more about just a tiny part of growing this business. And it should be, right? The 1,000 things you need to do to grow this business to full strength, the capital raising is, if you do a good work with customers, is one of them. And it is much harder there's a lot of things harder in climate tech. One of them is there's a lot of hardware businesses, so you can't just launch in the US and try 10 different markets around the world. Much, much harder. The second is that there is still this understanding of impact, is there an impact component to it? So that's really, really key. Cheers, Ryan. Good luck, mate. Close it. Good in the bank. Keep growing. There's complexity around measuring climate benefit and value. Like, we absolutely know that. So there are certainly challenges in doing a lot of that. Plus, also experts in this field. Like, investment is always a lagging indicator. So a successful VC fund is typically based on 20 years of prior activity of the team and the market. So the reason why we have so many SaaS investors now is because we've had 15 years of amazing SaaS growth. And 10 years from now, I hope we've got a whole lot of climate tech VCs, but there's just not enough of them on the table at the moment. So anyway, so we've 5 minutes to go. Is there any last minute questions or thoughts? Please, absolutely come along to the trade mission. We're doing this amazing trade mission to the US. We're going to meet a lot of investors over there. We're going to give lots of support through the process. We'd love to have as many companies be a partner as possible. Any company from Australia can apply to that, but New South Wales companies can get some additional benefit and some extra support, but any company can apply to be a part of it. So please follow that through. The other thing, again, reach out to all the mentors. Charlotte can connect you to other people and share with each other. There's still not enough founder. I actually think there's a lot of non-channel chat that happens, which is great, but please reach out to founders and mentors and get support through this process.
Hey, Mick, just a quick question. In terms of any tips for, I guess, reconciling what can often be philosophical differences between a VC world and climate tech? I mean, I'm still not sure that that's a path that we would want to go down under, because I'm concerned that the growth at all costs mentality will compromise the mission.
Yeah, so there's definitely even main sequence breakthrough ventures. There are others which are having much longer time frames, 15 to 20 years, which is good. So there's a lot more patience built into it. And Australian investors don't have the luxury of going for growth at all costs to some degree. There are differences there. And there are literally thousands of VCs around the world. So But I think again to Joanna's point, but also what you're raising there, like that's why you want to have a relationship, right? You want to know what they do in that alignment. We had a company that was non-climate tech, but they had a term sheet on the table. There was a particular issue about the company that they didn't know whether they should share or not. And I said, I would really encourage you to share it, because if they say they don't like it, then that's a big red flag and you should not do anything. So testing people's commitment to that can come in a lot of different ways. You know, what else have they invested in? How else are they prepared to support you? So it is a bit tougher, but I would also say don't shy away from financial sustainability of your business and those returns, because I know absolutely your business at scale can do a lot more than your business underfunded, but it's a really tough call because there's a new responsibility and it doesn't come for free, right? There's big amounts of money as a board seat and pressure. And, you know, again, the last 3 months I've seen CEOs fired and horrible things happen based on things not working out well. So you've got to get it right. But I think there's enough options. And again, part of what Climate Sale is trying to do is to find more of those companies that are definitely climate and impact returns and impact rather than just returns, but it's not easy.
Yeah, follow-up question, if I may, Mick,
Yeah,
because, g'day. So I'm Sherry V, and, you know, part of our story we're plotting out is, you know, 10 to 15 years of really good growth. And then if we've done things right, hopefully there's a little bit of a plateau. We've solved the problem, supported the transition, etc. And like, how does that story going to sell to investors and things like that?
Yeah, so I have a very strong view that all of your businesses are massively undervalued because the world doesn't fully value the climate problem and the climate transition and opportunity. That's easy to say, but much harder if you've still got companies on the line investors, like you're in the midpoint of the trough of sorrow of trying to creating the model and get that kind of growth. So it's hard to do, but this goes back to the relationships again, which is if you're only getting a financial investor and that's all they care about, then you have to have a strong financial decision, financial story. But my view is 90% of investors at a pre-series B stage is all about it's totally about potential, right? You're at best 1%, and it's your ability. This is why the dots to lines is important, because you saying I'm going to go up here and you're saying you're right down here. The belief of leaping off here to here is, if that's based on a dot, it's crazy hard, versus if that's based on 10 dots and getting to know them and being like, you know, Tim is going to pull this off. Like, it's going to take 15 years, but he's going to do it. I was asked recently, like, what's the one thing I look for? And it's like someone who it's their life mission. And it's a bit glib, but everyone's journey here is long and challenging. And if it's kind of like, I'll keep going, providing there's money and there's options there and it's really good fun, but you kind of want that unreasonable behavior, and someone's got to believe in it, which is impossible to get from a single pitch. Like, I can pitch passionately about all of your businesses within about 3 minutes of preparation. Like, it's just something I've done many, many times. But what's the follow-up? What's the fifth meeting? And this goes back to that communication, right, which is just enough to get the next meeting and build those relationships. But they've got to fully understand you. They've got to want to spend the next 10, 15 years with you. So, yeah. So not an easy one, but happy to do a direct follow-up on yours, because I know you've got big things, right? Like full infrastructure and full policy. Like there are 10 parts to that, which we all hope happen, but like that's pretty crazy risky to be like, oh, and one day,
Yeah.
but the tailwind.
We'll move beyond hope and try to make things happen.
Yeah, exactly.
Thanks, Mick.
No problems. So team, again, we're going to wrap it up, but plenty of great mentors and other founders who've been through this multiple times. Please reach out. right now, one of my biggest frustrations is that no one's annoying enough. No one's asking us lots of questions and asking for lots of help. Please just keep pestering us. That's why we're here. We're not going to help you directly because we're a small team, but we're going to pass you on to lawyers or accountants or investors or advisors or founders who've done this before. So thanks for coming on, everybody. If there's anything we can do to help, please reach out.
Do you want to do a group shot? Oh, you're on mute. If everyone can put their cameras on.
Cameras on. If you're up for it, and if you're feeling bold.
Yay.
Thumbs up.
Thanks so much. Oh, stop recording.